China's challenge to the global economic recovery. Hello lovely YouTube family, welcome back to the Wealthy Brains. In today's videos, we're going to talk about China's challenge to the global economic recovery. Before we start, I want you to hit that red subscribe button so that you never miss out on any of our videos. It has been long said of the United States economy that when the U.S. sneezes, the rest of the world catches pneumonia. With China now being the world's second largest economy and its primary economic growth engine, one has to wonder whether the same might be said of China. This comparison is all the more relevant today when the Chinese economic recovery is being challenged by a renewed outbreak of the COVID-19 pandemic at a time that several serious weaknesses cast a dark cloud over that country's long-run economic outlook. In the decade following the 2008 to 2009 Great Recession, China's impressively rapid economic growth made it the main engine of the world economic recovery. Its rapidly expanding economy provided growing export markets, especially for its Asian neighbors. Meanwhile, its insatiable demand for international commodities provided much-needed support to the emerging market economies. Over the past year, after a brief COVID pause, this pattern seems to have reasserted itself as China was the earliest among the world's major countries to bring the pandemic under control. That enabled its economy to recover rapidly from its COVID-19-induced recession. Once again, this provided growing export markets for its Asian neighbors as well as substantial support to a strong rebound in international commodity prices, so beneficial to the emerging market economies. A recent outbreak of the Delta variant in China poses an immediate challenge to its continued role as the world economy's main growth engine. Several Chinese regions have reimposed economic lockdowns as the Chinese government adapts a zero-tolerance approach to the pandemic. While such an approach is likely to be in the country's long-term economic interest, it will cause short-term problems for the country's economic recovery. Any Delta-induced Chinese economic slowdown would be occurring at a time that the country faces serious longer-term economic challenges. The government's recent crackdown on its high-tech sector, together with its efforts to give preference to its public sector over its private sector, represents at least a partial reversal of Deng Xiaoping's economic reforms in the 1980s that underpinned the Chinese economic miracle. At the same time, slower economic growth will make it more difficult for the Chinese authorities to deal with its credit market bubble, which is among the largest in the world. That, in turn, threatens to replicate in China the Japanese economic slowdown of the 1990s with a rise in zombie companies and the clogging up of bank balance sheets with non-performing loans. A Chinese economic slowdown could have serious spillover effects to the rest of the global economy. The U.S. and the European economic recoveries are already being hobbled by supply chain problems in the rest of Asia. China's Asian neighbors are struggling with their own Delta waves, which are inducing them to lock down parts of their economies. Meanwhile, the highly indebted and under-vaccinated emerging market economies are in a weak position to weather a renewed slump in international commodity prices and a contraction in their export markets. Equally troubling is the risk that a Chinese economic slowdown could burst the global everything bubble that now characterizes the world's equity, housing, and debt markets. These bubbles are premised on the assumption that today's ultra-low interest rates will last forever and that the world economy will continue to recover smoothly from its COVID-induced damage. A prolonged Chinese economic slowdown could throw that assumption into serious question and be the trigger that bursts the bubble. One upside to a Chinese-induced world economic slowdown is that it would reduce the risk of U.S. economic overheating and inflation from today's excessively expansive budget and monetary policy stances. But we would all be better off if China could somehow quickly contain its economically damaging Delta wave, and if the U.S. addressed the threat of economic overheating by tightening its economic policy. Desmond Lackman is a senior fellowman at the American Enterprise Institute. He was formerly a deputy director in the International Monetary Fund's Policy Development and Review Department and the chief emerging market economic strategist at Salomon Smith Barney. China has broken the back of the coronavirus spread and policy is shifting strongly to supporting economic growth. The challenge is huge, reflected in declines of 13.5% and 20.5% in industrial output and retail sales, respectively, in the first 2 months of 2020, and in February, the unemployment rate jumped to 6.2%, an all-time high. These data points suggest that a sharp contraction in China's first quarter GDP is inevitable. But even before the spread of the virus was brought under control, the government adopted multiple highly targeted policies to mitigate the adverse economic effects of locking down a large share of the country's population. Among the most important were the following. In early February, the central bank announced an RMB 300 billion or $42.47 billion re-lending fund to support loans to firms producing and distributing medical supplies. Later the same month, the government launched an additional re-lending fund, or RMB 500 billion, or $70.79 billion US dollars, with RMB 100 billion, $14.16 billion US dollars earned marked to support agriculture, and RMB 300 billion to support micro and small firms. On February 20, the government cut and in some cases exempted enterprise contributions to social insurance funds, including pensions, unemployment, and workers' compensation, at least through June. In March, the government announced that small firms that maintained their employment levels would receive a refund on all the unemployment insurance premiums that they had paid in 2019. In early March, the government instructed banks to suspend collection of interest and principal payments on loans extended to struggling micro, small, and medium-sized firms until at least the end of June. In mid-March, many provincial governments began to distribute vouchers to households to cover expenditures on specific items. Vouchers are better than helicopter money since they can't be saved. Also in mid-March, the central bank cut the required reserve ratio for certain banks, freeing up to RMB 500 billion in liquidity, which banks were directed to use to increase loans to micro and small firms. And that will be it for today's video. I hope you liked watching it. If you did, make sure to hit that like button and subscribe to the channel so that you never miss any amazing videos from us.